Good day and what is up, moneymakers? Before we hop into today's video, tap the like button, subscribe, drop a comment, join our free Discord channel, and check out our Patreon page using the links in the description. When I first started trading options, I did a bunch of research and thought I was prepared and ready to begin options trading. Then, when I opened up the Trading Options tab on Robinhood, I was still pretty confused and still had a hard time understanding what was displayed in front of me. Upon opening this tab on Robinhood.com or mobile, you will see the share price, strike price, break-even price, percent change, and premium or the price. For a first-time options trader, this might be a lot of information to try and digest all at once, even if you've done research prior. Let's break this down piece by piece. To start, we have the share price, which is the price the stock is trading at per share. This is the number you would see when selecting a stock on Robinhood in the top left corner of your screen. This is the value we will use to determine what options are in the money or out of the money. For calls to be considered in the money, the options need to have strike prices equal to or below the current share price, and out of the money need to have strike prices above the current share prices. For puts, it's the opposite. In the money options are the options which have strike prices equal to or greater than the current share price, and out of the money options are below the current share price. Now, you might be asking, what is a strike price? When you buy an option, you agree to either buy for call options or sell for put options a specific stock at a set price. The set price is called the strike price or exercise price for that option contract. As I explained before, the relationship between the strike price and the actual price of the stock determines whether the option is in the money or out of the money or at the money. If you're planning to invest in options, understanding the strike price is critical. Moving on from strike prices, share prices, in the money and out of the money explanations, we have the break-even price. The break-even point or break-even price of an options contract is the point at which the contract would be cost neutral if the owner were to exercise it. The way this value is determined is by taking the strike price and adding the time premium or cost of the option to it. Using Microsoft as an example, the strike price of the option I'd like to purchase is a $205 call for $2 per contract. The break-even price would be $205 plus $2 equaling $207 for the break-even price. The reason you would not break even if you bought $205 calls for $2 per contract and it executes at a $205 strike price is because you still spent $2 times 100 or $200 for time premium, meaning you would be at a loss due to the time premium cost. Next up, we have the percent change, which is the change in percentage of the option price from the previous close to the current trading time. For example, if option X valued at $1 times 100, which would cost $100 total, has a percent change of 2%, the value of the option increased by 2% or 2 cents times 100, which would be $2. The same goes into the change number that you see. It shows you the amount I calculated while explaining percent change, so you don't have to do that every time you want to find the price change instead of a percentage. Lastly, we have the time premium or price per option. This premium price is multiplied by 100 as an option contract represents 100 shares of an underlying company's stock. I usually do not let options expire and make my money on options through premium. I will, for example, buy a call for $100, and when the stock price increases the next day, I sell the option to someone else for $200 before expiration and let them take on the risk of holding the option while I get to walk away with an extra $100 of time premium money. Now, the way the option prices are determined, like I mentioned before, is if the options are in the money or out of the money, and how long until the contracts expire. In the money options are more expensive than out of the money options, and the further out till the expiration date, the more valuable the time premium is. I will be releasing content soon, digging deeper into factors that affect options prices like the Greeks or the information displayed in the stats area, which is a little more advanced than what is covered in this video. If this video helped you learn or understand the basics of options prices on Robinhood, leave a like, and subscribe for more Robinhood Options content. Drop a comment, join the free Discord, and check out our Patreon using the links in the description below, as it is always a tremendous help. And as always, have a great day.